Welcome, everyone. Thanks for joining. On behalf of Tavola Group, I'm excited to have you here for our session. If you ever felt limited by traditional retirement accounts or wondered how to have more control over where your money goes, you're in the right place today. Today, we'll walk through how self-directed IRAs give you access to alternative investments and how those options can help you build long-term wealth. My name is Matt Schumacher, and I am the Director of Tax Planning here at Tavola Group. I'll be your host for today's session. Today, we'll be exploring self-directed IRAs, including what they are, how they work, and the opportunities they provide for investing in real estate, private equity, and other alternative assets. Before we dive in, a quick note: Tavola Group and its employees do not provide investment, tax, or legal advice, nor do we endorse any specific investment products. Today's session is for educational purpose only. We strongly encourage you to consult with your own attorneys, accountants, and financial advisors before making any financial or investment decision. At Tavola, everything we do starts with strategy. We take proactive approach, anticipating opportunities and challenges to help our clients build wealth while minimizing risk. We also believe wealth is about more than just numbers. It's about family, opportunity, and legacy. That perspective shapes how we guide our clients every step of the way. We know your time is very valuable, so we appreciate you taking the time today. But we've built systems that make process efficient, seamless, without sacrificing quality. And most importantly, we take a collaborative approach. Your accountant, your attorney, your advisor, they're all working in silos. We bring everyone to the table to ensure your strategy is fully aligned. So before we get deeper into self-directed IRAs, it's important to understand the foundation we want to talk about today is tax planning. Tax planning is the strategic process of analyzing your financial situation to minimize tax liabilities and maximize savings while staying compliant with current tax laws. This includes identifying opportunities to reduce taxes through custom strategies, ensuring compliance to avoid penalties or unnecessary risk, structuring assets in a way that supports long-term wealth preservation, and navigating complex tax rules with expert guidance. When done correctly, tax planning becomes a powerful tool, not just for saving money today, but for building wealth over time. Tax planning isn't just a once a year activity. It's an ongoing strategy that impacts nearly every financial decision you make. Done right, it can help maximize your savings through tailored deductions, reduce risk of audits and penalties, improve cash flow by timing income and expenses strategically, support long-term goals like retirement and business growth, adapt to major life changes, and ultimately preserve and grow your wealth in tax-efficient way. This is especially important when we start talking about alternative investments inside retirement accounts. One of the biggest misconceptions is that tax planning is only for the ultra wealthy. In reality, it's a practical and valuable strategy for a wide range of individuals and business owners. At Tavola, we work with real estate investors and developers, small to mid-sized business owners, high-income professionals like physicians, attorneys, consultants, entrepreneurs, founders, and family offices and wealth managers. If you're earning, investing, or growing a business, there are likely opportunities to improve your tax strategy. It's worth asking, could you be leaving money on the table? A lot of people are, not because they're doing anything wrong, but simply because they haven't taken a proactive approach to taxes. We offer a complimentary tax planning consultation where we review your current situation and look for ways to improve efficiency, add clarity, and potentially reduce your tax burden. There's no cost and no pressure, just a chance to get a clear picture of where you stand and what options you might have. If you're interested, you can email me directly or fill out a free consultation form on our website. Now, I'm excited to introduce our guest speaker for today's session. Matt Moore is a business development manager at CamaPlan. He brings over a decade of experience in fundraising, where he worked closely with investors who utilize self-directed IRAs to participate in private investment opportunities. In his current role, Matt partners with capital raisers and professional networks to provide education around self-direction and help investors better understand how to take control of their retirement funds. He has a strong understanding of both the investor perspective and capital raising side, which gives him the unique ability to connect strategy with real-world application. I'll now hand it over to Matt Moore to walk through how self-directed IRAs work and how you can start leveraging them for alternative investments. Matt.
Awesome. Thank you very, very much. Appreciated the introduction, but I also appreciated kind of everything you were talking about, tax planning and the benefits of it. That's like, the perfect platform to prepare for thinking about this presentation that I'm about to give. There's I'll give you kind of a quick shout out. I'd say there's a certain camp of tax professionals who don't know about self-directed IRAs. Response is to just sort of advise away from them. But at the end of the day, a self-directed IRA is serves that the bullet you had at the bottom of one of those slides, preserving wealth through tax strategies. So hats off to you for wanting to create more self-directed IRA knowledge for the benefit of your clients and your network, Matt. So just a little bit about CamaPlan. We are a self-directed IRA administrator based out of Ambler, Pennsylvania, which is about 30 minutes northeast of Philadelphia. We opened up shop in 2004, and we have somewhere in the neighborhood of about 7,000 clients plus in all 50 states, Puerto Rico, and DC, and somewhere in the range of about 1.3 billion of assets under administration. We have been able to really build that client base from being focused on good customer service, among other things. But good customer service is paramount to the owners. They're both real estate investors themselves, they're entrepreneurs. They spend plenty of time dealing with financial services professionals. They don't like being on hold, and they don't like going through complicated phone trees or getting incorrect information. So having a reliable team that's available to answer our clients' questions has always been very, very important to them. And not only that, it's also important to make sure that as we're introducing self-directed IRAs to people who are just learning about them, there's has to be a lot of education. There's a lot of hand holding that goes on. And so that includes doing webinars like this, or, creating educational collateral. It also just means just being on the phone and talking to the client's advisor or their CPA or whoever, so everyone's on the same page. And to take it a step further, one of our owners, Carl Fisher, he's actually certified to do professional continuing education for financial professionals. So think about, advisors, tax attorneys, realtors. He gives presentations to these folks on how they can advise their own clients about using self-directed IRAs. So today's agenda, we're going to try to keep it pretty high level because we have about 30 minutes or so. We don't want to go. I don't want to bang you over the head with a bunch of granular IRA in the weeds kind of information, but we also want to have time for questions, of course. So we're going to go over just what are self-directed IRAs, the benefits of using them, what you can and cannot do with them. And we'll actually look at some examples too, at least one example of what a self-directed IRA in action kind of looks like, and then I'll walk you through how that process works. Cool. So starting at the top, what is a self-directed IRA? If you imagine kind of your run-of-the-mill IRA at a brokerage like a Schwab or Fidelity, it's going to give you a menu of things that you could invest in, and they're all kind of based around publicly traded assets. Think stock market, bond market kinds of investments. And so, if you want to invest outside of that menu of options, you need to go to a company like CamaPlan to open up a self-directed IRA, and because you want those options. And so, the first kind of theme about a self-directed IRA, it's going to come up a lot, is this idea of control. It gives you more control on where your where your capital is deployed, and that control allows you to invest in alternative assets, or I like to call them private assets, because I think they're becoming less and less alternative, and they're just becoming a different asset class themselves. So private investments, investments, alternative assets, these are all things that are typically not going to be available through a Schwab or Fidelity, like a brokerage like that. And so you need to come to CamaPlan to be able to hold those. And we'll walk through some of those examples later on the deck. To be able to invest in these things through your tax advantage retirement capital, you have to have a qualified custodian. So the IRS requires that a custodian be in place to administer these retirement accounts. So whether it's investing in the stock market or you're buying real estate and oil and gas, you have to have a third party be in place, and CamaPlan checks that box as being the third party as a qualified custodian. And the last theme is about diversification. You're going to have the opportunity to diversify your portfolio into something beyond the stock market or the bond market, and have true diversification that you wouldn't otherwise get if you were not using a self-directed IRA. Okay, so why would you want to consider a self-directed IRA? Kind of touched on it a little bit on the last slide, but to kind of take it a step further, you're going to have more investment options. So I'll use precious metals as an example. If you like investing in uh, uh, gold ETFs, for example, but really you'd like to actually hold gold in your IRA, then that would be something you could do with a self-directed IRA. You being in the driver's seat kind of comes back to that idea of control. It is built into the name. It is self-direction. You are the one who is taking control of your retirement account, and you are making the investment decisions on what you invest in. You do the due diligence. Companies like CamaPlan, we don't advise. We just provide the service of holding the accounts, and then you're the one who is able to do the due diligence and make your investment decision using your tax advantage retirement capital. Higher return potential. So certainly if you are in a portfolio that's getting 5 to 10% returns annually, you want something greater. You could definitely find a more aggressive strategy in with a brokerage. But if you want to go invest in venture capital or something like that, yes, there's a higher risk profile, but there's going to be a higher return potential as well. And these are some things that you could do with a self-directed IRA. And then the last one is portfolio risk reduction. So how are you hedging your portfolio kind of against might be happening in the public markets? Um, this is something that you could do through precious metals, for example, or real estate assets, which you could hold in a self-directed IRA.
Matt, I did get a question from somebody. They said, are these self directed IRAs the same kind as what is offered by larger brokerage institutions?
Great question. I have a Roth IRA with Chase, and if I open my app right now, it says self-directed IRA. So this is kind of a misnomer because it is self-directed in the sense that I can go and choose to invest in Nvidia or Microsoft or Tesla. I can go and make those decisions. I don't have to. Um, I'm not tied down to a specific strategy that I don't have any control over. So in that case, yes, there's a kind of self-direction component to it. But when we talk about self-directed IRA in the context of this presentation today, a true self-directed IRA is one that allows you to invest in all kinds of assets that are beyond the stock market and bond market. So that is a long way of saying that to answer the question, this is something different. This is something that if you have a Fidelity IRA, just as an example, and you said, I want to go buy an investment property, I want to go buy a house with my IRA, they're not going to let you hold that asset. The self-directed IRAs that we're talking about today that CamaPlan provides does let you invest your tax advantage retirement capital into those kinds of investments.
Awesome.
This quote that you see here in front of you is actually from our client, one of our clients, and we like it because it really captures what we're all about. So this individual, he is a retired real estate broker, and he had an IRA that he was contributing to, and it was with an advisor, and it was in the stock market, and it was doing fine. But he had built up all this knowledge about real estate by virtue of being a real estate broker, and so he, by his own admission, knew very little about the stock market, but he knew a lot more because of his professional experience about real estate. So once he discovered self-directed IRAs, he was like, "Oh, this is fantastic because now I can take some of my existing IRA money, put it in an IRA with CamaPlan, and then deploy it into real estate opportunities that I can underwrite very well, or I understand what's going on, or I know the sponsor, whatever the aspect is." And so it gave his professional experience gave him an edge in being able to deploy this capital. So the quote is investing in what you know, understand, and can control versus using hope as your strategy. So the types of self-directed plans are kind of align very well. They align with the same kinds of plans that you might see at another institution. So the most common accounts that we have are going to be the traditional IRA and the Roth IRA. But kind of taking a step back, if we want to put them into buckets, you're going to have your tax deferred plans and your tax free plans. And the analogy that we like to use is taxing the harvest versus taxing the seed. So taxing the harvest is applies to the ones on the left, like the traditional IRA. Very, very popular. It's all pre-tax money. You contribute the pre-tax money to that account. It grows, but then when you take your distributions, when you're able to do so after you're 50 over 59 and a half, you will be taxed on that money on those distributions based upon your tax bracket at the time. So this was designed with the intent that people would have been retired from their careers. They'd no longer be making the same size salary as they were when they were working, and so they'd be in a lower tax bracket, and it would be beneficial to them. And for a lot of people that is the case, but for the entrepreneurs out there, people who plan to be at a high tax bracket into their 60s, 70s, and onward, there's really no relief when they have to pay that tax bill. So the Roth IRA was created in the 90s, and it allows for tax-free growth. So the money that goes into the Roth IRA is post-tax dollars, but then it grows tax-free. So we are very partial to the Roths over at CamaPlan, and they're very popular with our clients because often investors who are using self-directed IRAs, they are investing into opportunities where they're going to potentially see a lot of growth, like a real estate or venture capital or something like that. And so because they're anticipating there's going to be a big capital gain, they elect to invest post-tax dollars or Roth dollars. But again, traditional and Roth, those are just probably the most popular ones, but there's a variety of each kind of account. If you look at the whole list, health savings account, which people are probably well aware of. Not a lot of people realize that you can self-direct those. Same with the educational savings accounts. So once you start to kind of uh, have the appetizer of the traditional self-directed IRA or the Roth self-directed IRA, and you get comfortable with it, then you realize, oh, there's a lot of opportunities for me to be able to grow these accounts faster and use them for specific events coming up in life, like anticipated health expenses or paying for college, things like that. The other big consideration about these two different categories of plans is just the required minimum distributions. And being that I'm being hosted by a tax advisory group, I'll tread lightly here. So if you need to correct me, Matt, by all means, please speak up. But at a high level, there are required minimum distributions on the tax deferred side, so on the traditional IRA side, and there are no required distributions on the Roth side. And this applies for self-directed or standard IRAs. Where this plays a factor, though, for self-directed IRAs is that often, if you are investing in something that's going to be illiquid, so again, think real estate here, um, you're going to have to plan strategically how you're going to be able to work that asset into the required minimum distribution calculation that you'll make. So if you have a bunch of non-liquid assets and you have to make RMDs, that's going to be an issue. It's going to kind of force you to have to liquidate those at a timeline that you weren't really thinking. So it's not that it can't be done. It's just it takes more planning, and takes, I'd say, even more consideration if you're investing into illiquid assets like you would like is often the case with self-directed IRAs. On the Roth side, or the tax-free side, excuse me, there are no RMDs, and so just it's an added benefit to give you more control about what you invest in. And if you are thinking about legacy planning and you want to be able to pass down the assets in your Roth IRA, or pass down the Roth IRA and its assets to a beneficiary, and you want those to be held, like a real estate asset to be held, the lack of RMDs gives you kind of even more options than the traditional would be.
Matt, I just got a question from somebody, and I think we might be covering this later, but
Mhm.
is there anything I can't buy asset wise in a self-directed IRA? The example they put is, could I buy into collectible coins or something more obscure like that?
Good question, and we will cover it. So hold that thought. We're going to get into it in about, I think, probably give me 8 to 12 minutes.
Perfect.
Cool. So we can go through these quickly. I'm not going to read everything on the text of these slides, but we're going to go through some examples of common investment opportunities, or common investment assets that we see by CamaPlan clients, and certainly just clients in the self-directed IRA space. The most popular asset class for people who are using self-direction is going to be real estate. Buying the assets outright, lending on real estate backed notes, or investing into private placements, which we'll cover in a different slide. It's real estate's um, very attractive to self-directed IRA investors because people understand real estate, and they understand that the benefits of, if you're going to have a buy and hold strategy, why that would play well into a self-directed IRA, particularly a Roth self-directed IRA. Excuse me. Next slide, please.
Really quick, someone just had
Sure.
a question about real estate outside of the United States. Can you own real estate outside the United States with your self-directed IRA?
Yes, you can. Great question. So if you want to own an apartment building or a condo, or you want to own land, you can do that. And if you want to own that real estate outside of the United States, that's also possible. So this sky's practically the limit with self-directed IRAs in general, but in real estate too, there's lots of options available.
Cool.
So precious metals, very popular with self-directed IRA investors, just because of the strategy of the growth, but also the timelines. The timelines really align well with a self-directed IRA strategy. It is a kind of a nest egg growing um, account. So, and a silver right now, or I said silver in the past 48 months was very, or 24 months has been very popular. But you can own gold, silver, platinum, and palladium in your self-directed IRA. To the question about coins that was asked earlier, um, I'll go into this a little bit more. There are some coins that are allowed. The IRS has a list, and uh, they have to have a certain what's the word? Composition of gold, or certain purity of gold or silver to be allowed. But when they're like these obscure collectible coins, um, that's sometimes they're okay and sometimes they're not. But typically, just buying pure gold or pure silver, um, that's kind of the cleaner way to go in the eyes of the IRS. So um, we always encourage people to do a lot of due diligence with the precious metals dealer they're working with, and make sure that everything's in their operations.
Yeah, question about the precious metals. Where is the precious metals physically held? Is that something they hold on to, or is that through a broker?
Good question. Yep. So because a self-directed IRA or an IRA is its own entity, it has its own EIN number. Um, the individual account owner can't hold the assets physically um, in their own, have them in their own possession. So in the case of precious metals, they have to be held at a depository, and they're held that depository account is administered by CamaPlan in this case, and we go and we'll do audits probably like on an annual basis, where we go visit the sites in Delaware. That's where both of the depositories are that we use, to make sure, okay, we see everything there, everything looks good. But yeah, the the precious metal can't be held by the individual themselves. It has to be held at a depository. Private equity and startups. I kind of alluded to this a couple times earlier, but yeah, think venture capital or private companies that haven't gone public yet, where the investors anticipating a big capital gain. I'm working with a client right now. He is a doctor and he is invested into a company that's doing early stage cancer, breast cancer detection through like an AI application. And so he has a lot of knowledge in that area as a physician, and he's anticipating that the company is going to go public and his investment's going to like 6x or something, like, I think 6x or 10x. So he's doing it. He did a Roth conversion, so that he moved pre-tax dollars into tax dollars in a Roth account. And this is an example of someone using their professional knowledge and participating in a private company that wouldn't normally be available through a Fidelity or Schwab. Crypto, similar to precious metals, uh, you can hold crypto through a self-directed IRA. There's certain platforms that are crypto trading platforms that are kind of a little bit um, more amenable to IRAs than others. So we have a couple of groups that we work with who allow IRAs to hold the cryptocurrencies in them. It just sort of depends on what the rules of that platform are. They're actually I've learned, and I'm still learning kind of about the idiosyncrasies of each of the platforms and how they work. Not all platforms allow you to hold, not all crypto platforms, a lot of crypto platforms don't allow you to hold assets in an IRA. So, as if this is something you're wanting to do or are thinking about doing, it's good to work with a custodian who can point you in the right direction or has a partnership set up where they're working with a platform that'll allow you to do this. Partnerships. I'd say this is probably one of the maybe the second most popular investment structure for our clients. Um, if you think about real estate funds or anything that's where it's through a private placement memorandum, that's how the investment is structured. These are very popular with our investors and a lot of self-directed IRA investors in general, because they allow these investors to go into private assets, usually real estate, where they can access bigger returns or diversify their portfolio. But at the same time, they don't have to become the landlord. So it still kind of maintains a passive relationship to the retirement account that people have grown accustomed to using brokerages, and they're not having to go from hot and cold and all of a sudden they have to be really really involved. They have to do due diligence on the sponsor and the operator who they're investing with, but it still allows them to be a passive investor in an asset class or in an investment structure that wouldn't otherwise be available on one of their other brokerages. I want to go into the weeds a little bit about an investment, like what an investment would look like using a self-directed IRA. And so picked this one. It is a syndication into a mobile home park, and it's a real example. It's from a sponsor I've worked with, and it kind of has, I'd say, pretty realistic return projections in terms of what I've seen around kind of at least the mobile home sponsors that we work with. So, um, just to break it down a little bit, we're looking at an investment size of $50,000. The projected term is 5 years. There's a projected preferred return of 8%, and they're projecting an equity multiple of 2.8x, and it's a 70-30 equity split. So if we follow the breadcrumbs of those projected returns, we're expecting a cumulative cash flow of about $26,000. The equity share will be about $45,000 with a total return net of principal of about $92,000. Cool. Okay. So on the left-hand side, you have this investment in a Roth IRA, a self-directed Roth IRA. On the right side is non-qualified funds, which is IRA speak for just non-IRA money. So non-qualified funds is on the right, IRA money is on the left. If we start with the non-qualified funds on the right, you'll see that this investor who's at a 37% tax bracket is going to get hit with income tax, and they're going to get hit with capital gains tax. And so their overall return is going to come down significantly, about in the mid 60s. On the left hand side are is the qualified funds tax-free Roth IRA. There's no income tax, there's no capital gains tax. There is this thing called UBIT, unrelated business income tax. So that will reduce the investor's return by about $3,000, and then their net return is going to be about $88,000. So when we kind of do this side by side comparison, we can see how this investment might look using a Roth IRA, but also that if the Roth IRA is used, it can actually come out ahead of using non-qualified funds.
Really quick, Matt, what is unrelated business income tax? I'm not familiar.
Okay, good question. So unrelated business income tax is, kind of think of it as we'll call it a mechanism for the IRS. So the IRS allows for, or has written in the tax code that you can have an IRA, a retirement account. And the nature of the retirement account is that it's meant to hold passive investments. Think, public equities, things like that, precious metals, things like that. If you start to do things that are no longer passive, then you're kind of breaking the intent of what those accounts were meant to be in the first place. And so there's two triggers that can lead to unrelated business income tax. The first is if you own a business inside your IRA and it starts to generate profits. Well, this is not passive. It's not considered passive. So the IRS is going to tax you on that, and it's going to be based upon the tax bracket of the individual account holder. This profits doesn't apply in this case. The other trigger is unrelated debt finance income. So if leverage is used in a deal and that leverage is to the benefit of the IRA in terms of a return, then this is again beyond the intent of the passive nature of the IRA in the first place, and that is what we're seeing here in this case. So this sponsor is using debt for this mobile home park, and because they're using leverage and they're taking money out of the debt pool, and it's being used in this case by a tax advantaged IRA. The IRS is saying, hey, that's not really what this was meant to do, so we're going to tax the amount that benefited we're going to tax the amount of the return that benefited from this loan. So if the loan has a 70% loan to value, then they use that 70% to um, determine how much they're going to tax. And again, it's taxed at the client's tax bracket. So two things to note about this. Number one, CamaPlan, we don't like taxes, just like the people on this call probably aren't, wanting to fork over all their hard-earned income for taxes, and you want some tax strategy. We understand that, but we look at UBIT, unrelated business income tax, as a good thing, because the alternative is that the IRS could say you can't take leverage out on deals, and they just do away with it altogether. So we think of this as a good thing, because at least they've created this mechanism to be able to allow people to use leverage and enhance the buying power of their IRA to participate in bigger deals. Um, the other thing is that depreciation is not something that IRA investments can benefit from. So, um, using our investment here, the personal funds investor would be able to benefit from depreciation that the sponsor passes on to them. The IRA does not get to benefit from that depreciation because it's already tax advantage, except in the case of unrelated business income tax. That depreciation can be applied to that portion that's having the tax assessed on it, and can actually reduce how much the IRA will be taxed on it. So even with UBIT in place, unrelated business income tax, there are ways to reduce the UBIT liability through depreciation.
Awesome. Thanks.
To that question that we got earlier about prohibited investments, the key word was collectible coins. So, it can be kind of, you could have a coin that qualifies as, in terms of like how much gold it has in it. It might actually qualify and be okay to be held in an IRA, but you just got to be careful of those coins, and if they're being called collectibles. Often collectibles is a no-no for collectible coins are a no-no for IRAs, and collectibles in general are not allowed. So no baseball cards, no bottles of wine, no rugs, um, things like that, and then no life insurance policies can be held inside of an IRA. The other side of the prohibited coin are going to be on the prohibited transactions. And this is especially if for real estate investors, like we might have on this call, this is something to keep in mind. So if you zoom out, just think that the IRS says your IRA is its own entity. It cannot benefit from you, nor can you benefit from the IRA personally. So that means that you cannot go put sweat equity into a house that is held by your IRA, because that means that the IRA is benefiting from you, the individual. You have to actually you have to have someone who will come in, and you'll pay them a wage to do that work, and that way that person's compensation can be taxed, basically. Alternatively, if you own a property in Hawaii, for example, and you're going to use it as a vacation rental, you can't decide to go and stay there for a little bit and use it, because now you're benefiting from this asset that's held inside of your IRA. This also applies to certain family members. Anyone of lineal ascent or descent is not allowed to benefit from the IRA or provide benefit to the IRA. So what does that mean? No grandparents, no parents, no spouses, no children or their spouses, no grandchildren or their spouses. Another way to think about it is, if you kind of think about the people in a family line who would often like benefit from a will, those are the folks who can't be providing benefit to an IRA or receiving benefit from an IRA. So what's an example of this? Imagine you buy a property in Oxford, Mississippi. You're going to rent it out. It's a 4-bedroom house, and you're going to rent it out to students who are attending Ole Miss. And your daughter goes to Ole Miss, so your plan is to have 3 of the rooms rented out, but then your daughter's going to stay in the 4th room. Well, if the property is held in your IRA, you can't do that. So it's just some of these. There's just some things you have to be careful of. For the most part, people tend to keep everything at arm's length, and this is not an issue. But I think what I find for real estate investors specifically is that they are used to managing their own properties and doing things themselves. And so the idea of owning property inside an IRA sounds awesome, but they have to remember that they can't go and manage it in the same way they do with their non-IRA properties. How does this whole thing work? Um, it's pretty straightforward. And I know maybe I'm just the guy saying that because I do the job, but I literally just did a rollover of my own, an old 403B. So I now feel like I can really walk the talk at this stage. But how the process works is you open the self-directed IRA with CamaPlan. You go to our website, you open the account. That takes about 15 minutes. The second step is that the account has to get funded. Most people are in funding their account in a rollover or a transfer. Now, technically, you can fund your account with a contribution, which is has a limit of $7,500 a year as of 2026. But when investing into these alternative assets, often the investment size, like the example I showed you, is $50,000, $100,000. If you're buying a piece of property, it's going to be hundreds of thousands of dollars. So usually that money is coming from an existing retirement account. So if it's like an old 401k, for example, that'll be a rollover. If it's a existing IRA, that's going to be a transfer. Either way, you indicate how you're going to fund your account during the account opening process, and then we will work with your custodian or work with you to work with your custodian to get those funds moved over. Meanwhile, you're going to want to pick your investment. Usually, people, when they're starting the IRA process, they already have the investment in mind. So, this picking the investment step usually happens first, but fulfilling the investment paperwork is going to be what you're going to do while the money is coming over. And this is kind of a unique part of the investment process too. When you own investments in an IRA, because it's its own entity, the investment is actually titled to the IRA. So using me as an example, instead of my investment that I just recently funded being titled to Matt Moore, the investor, it's CamaPlan FBO for the benefit of Matt Moore IRA. And CamaPlan signs the investment paperwork, not me, Matt Moore. So that is that applies to all investments. It's something just to be aware of as a part of sort of the process, and as you're thinking about how long this is going to take to prepare, you just want to keep that in mind. I should add that the funding the account step, that takes the longest amount of time. That can take about 2 weeks from the money to go from one custodian over to us. We don't have any control over that. That's up to the place where the money's coming from. It's just sort of the general timeline of the industry, unfortunately. But once we get the money, we're usually pretty fast. We turn things around in about 48 business hours. So now you've opened your IRA, you funded your account, you have your investment taken care of. We signed it, and we send the money off. And now we hold the asset while the money is working. So if it's owning precious metals, or if it's in a equity real estate fund or whatever that is, we hold the asset, and then any kind of distributions are made back to the CamaPlan account. Or if you have to pay for improvements to a real estate property, for example, those are made through the CamaPlan account. So that's pretty much it in a nutshell. So if you're going to kind of, if you're thinking about this and, you know, what, if, is this going to be the right strategy for you? Is this something that you want to do? I'd kind of focus on the benefits, of course, of what this is going to provide you to make sure this, what are the benefits, and is this the right thing for you? But at the end of the day, it's going to give you more control about what you invest in. It's going to allow you to diversify your portfolio, and it's going to allow you to potentially access greater returns through those investments. Now, of course, it's all about self-direction. So you're going to be the one who's in the driver's seat. You're going to be the one who's going to be making those investment decisions. We don't do any due diligence on your behalf. So that's an added layer as you think about, okay, how much control do I really want over my retirement and capital? And is this the right move for me? Um, and then, of course, like, why do I need to work with CamaPlan to begin with? Well, it's because we fulfill a required step that the IRS has in place. So a lot of this comes down to multiple conversations, especially for people who are new to this. And as I mentioned earlier, it's not just conversations with you, but it can be conversations with your CPA, your advisor, whoever that would be. But we want you to think of us as being an extension of your financial team, and we want you to be really comfortable and knowledgeable about what exactly is going on with this self-directed IRA strategy.
Awesome. Well, thank you for joining us today and for the great questions. If we didn't get to your question, or if you're thinking something afterwards, you can always send those via email. Our contact information is here. We really do hope that you're walking away with a clear understanding of self-directed IRAs and how you can open the door to investing into real estate, private equity, and other alternative investments. Matt, I want to say thank you for your time and expertise. Your insight really made this topic much more approachable and practical for not just me, but for everybody on the call today. Um, Again, if you guys like to keep the conversation going, Tavola offers a complimentary consultation. You can reach out to me directly or go to our website to fill out a sign. If you have more specific questions about self-directed IRAs, feel free to reach out directly to Matt Moore for additional information. We'll also be sharing this recording of this session on our YouTube channel soon, so you can revisit anything at your convenience. Thanks again for being part of this. We appreciate your time and look forward to connecting with you again soon.
Thank you
Thank
very
you.
much.